want to do what I
and we'll put this here so that it.
Good morning, everyone. We'll wait for a few more seconds for people to get on. Can everyone hear me okay? Give me a thumbs up if you can hear me. Thank you. Yeah, I keep those thumbs up coming. Yeah, lots of thumbs up. Love it. It is 10:01, so let's get started. Before we get started formally, let me just go over a couple of housekeeping things. We remind everybody that we're doing these webinars every month, the second Thursday of each month. And so the next one is going to be Thursday, September 12th. We're going to be, the topic is, what should I do with my old 401k? So a lot of people have money at their old company and their old 401k plan. And so we'll be talking about the different options there, keeping it, moving it to your new 401k, moving it to an IRA. Those are roughly the options. So we're going to be reviewing the pros and cons there. We are also launching a weekly podcast in September. That's going to be starting on Mondays. Monday, September 9th, I think is going to be our first one. We will be sending you some information about that as that comes closer. Also on our Instagram, we will be sending little teasers to let everyone know what's coming down the pike. So we remind everybody, please, sign up, like us, subscribe on our Facebook, Instagram accounts. Be sure to follow us on Instagram. So those are a few housekeeping things. We'd love our follower count to go up. This is our fourth webinar, and we have had consistent participation and people coming back to the webinar. We're really pleased to see that. But let's go ahead and get started now. My name is Ben Driggs. I'm the president of Navigate Financial, and this is our monthly webinar. Today, we're going to be talking about how the stock market works. So if you have any questions, submit those. I am going to toggle back and forth from the presentation, and then every once in a while, I'll check to see if there are any questions. And also, we have a couple of other people who are going to be monitoring the question board as well. So thank you again for joining. Let's start. We're going to end promptly at the bottom of the hour. I will remind everybody so that they don't get nervous. I'll be sure to keep on script, and let's start going. So today we're going to be talking about how the stock market works. We'll cover 6 areas: what it is, how the stock market works generally, then evaluating the worth of a stock, common ways to categorize companies, different areas of the stock market, we call those asset classes, why it's difficult to time the market, and why we need to view investing as a long-term thing. So the first thing we're going to do is talk about kind of the history. I had put a YouTube video, 1-minute thing that I pulled YouTube that I thought was good. But in the end, in the interest of time, I decided to scrap that. But let me explain how stocks originated. It was in like 1500s, 1600s. You had the British who were colonizing, like the Americas or other areas around the world. And so they would send out ships to go find resources in their colonies. They would bring those resources back and make a profit on that. Well, sending a ship out is very expensive, and so they would get their friends together and they would pool that together in some sort of a joint venture, and that then became somewhat of a legal entity saying, hey, this mission is going to be the XYZ mission. And then that was successful and they made a lot of money. Other people started getting involved as well. And so that kind of formalized the idea of a stock. So people would have a stock, it would diversify their risk. Instead of just going out on one ship, they would create a company that would send out many different ships. So the advantage there was that they could own shares of a company that the company owned lots of ships. So that's the background of how the stock market originated. Today, jumping to current times, we have publicly traded companies and privately traded companies. So when you create a company, you can either have a private company or a public. So a private company is just like our company, Navigate Financial. It's a company or private, small company. Almost all private companies are small. But then there comes a point in a company's evolution that if they become very big and successful, they may want to become a publicly traded company, which means anybody can own a piece of that company. Whereas a small company like Navigate Financial, that just has a couple of private owners. Anyone on this call couldn't say, hey, I want to own Navigate Financial. But let's say that Navigate Financial wanted to become public, then everybody could do that. The main reason that people go public, companies go public, is that they want to grow and they need investment. They need more capital. They need more money. And so they make a decision to say, hey, we can do better on a publicly traded market. Speaking of market, you have a stock exchange and a stock market. So let's talk about a stock exchange. We still have stock exchanges by all means, but with today's technology and computers and whatnot, they're becoming a little antiquated. But historically, the stock exchange would be the place where where people would come together to buy and sell stocks. So that's why you have an exchange, some sort of a market. That is not to be confused with the stock market. The stock market is the term given for all of the companies together. So you'd say, how is the stock market doing? Oh, the stock market is up. The stock market is down. You wouldn't say how is the stock exchange doing? You might say, is the stock exchange working? Potentially, it could have some sort of a technology, a glitch or something. But the exchanges do serve a purpose to keep things regulated, monitored, that there's trading going back and forth. And there are exchanges. several major exchanges throughout the world, the New York Stock Exchange, London, Japan, the Tokyo Stock Exchange, etc. Individual stock versus actively managed mutual fund versus an index fund. We won't go into that too much, other than to say an individual stock is when you buy Apple or you buy, Amazon. When you buy a company directly, you own shares of that company. And that direct ownership is sometimes advantageous. But it's difficult to own and properly diversify a portfolio, right? So you'd have to own Apple and Amazon, Google, Tesla. Those are a few big, US companies. But let's say you didn't have the time or the interest to do all of that. You might hire another company called a mutual fund. And a mutual fund company, what they do is they say, hey, layperson, don't worry about that. We are going to pick a whole bunch of companies, put them in a basket for you, and you're just going to own shares in our basket, similar to back at the beginning of the stock when we started this presentation. So there are third parties involved in just kind of managing that whole experience for the investor, and you pay them a small amount of the portfolio to do that. And then the last one is an index fund, where it's similar to a mutual fund that you have professional managers putting things together. An index fund is just a computer generated, no one is monitoring that per se. They're just saying, hey, we're going to put together the top 100 biggest companies in America, for example. We're going to call that an index, and you buy shares of that index fund, and now you own something that represents the top 100 companies in America. The last thing we'll talk about on this slide is the transition from stockbroker to a financial advisor. So many years ago, you would have people like me in this profession, and that person would buy and sell stocks for you. So, I might call a client and say, hey, McDonald's is a good buy. And then the client would say, yeah, let's buy 100 shares of McDonald's, for example. That would be what we refer to as a traditional stock broker. And that broker would get paid a commission to facilitate that transaction. And then the financial advisor, it has evolved into, well, I'm just going to be giving advice. Maybe you buy McDonald's, maybe not. And so rather than getting paid on a transaction basis, a financial advisor charges a fee to say, I want to provide advice. And that advice must always be in the client's best interest. So I think that might be, are we ready? Yeah. Are we ready for questions? Let me see if we have some questions. Okay. There's a question here, which is better, private companies or public companies? They're both good. Public companies are generally bigger, and so one might think bigger is more reliable. They would have more brand awareness than in a small company. So maybe from a recognizability standpoint, public companies might be better. Over the long run, I would say on a diversified basis, private companies tend to do a little better, but that's really tough. It depends on the company. So any other questions there? Okay, we'll move on. We'll come back to other questions. Just submit them. It is now 13 after the hour, and we're moving along just fine. So let's go now to second thing. evaluating the worth of a stock. So there are 2 slides here. We're just going to talk about a half a dozen ways or so how we can say, oh, is a stock good? Number 1, is there demand for the goods and services, right? We want to buy something that people want to buy. The company is trading in an area that people are interested in. Is the company profitable? Interestingly, a lot of companies that people invest in are not profitable yet. So you're investing in the company's future, but all other things being equal, of course, we want to invest in companies that are profitable. If not now, that we have a lot of confidence that they're going to be profitable in the near future. Is the company in debt, right? We don't want to be investing in companies that are weighed down with debt. Does the company have good management? Is the stock price comparable to the intrinsic value? So when we're investing, we're trying to evaluate really what is this company worth? And there's so many different metrics. Are they making money? How much money are they making? Their debt? Very, very complicated. And finance people are looking at this all the time. But it's difficult to say really what is the company worth. Ultimately, the stock market is making that determination every second. So we say, how much is Apple worth? Well, millions of people around the world right now are pressing their buttons and buying and selling because they think it's worth more or less. So there's not really a true value of a company. It's what the market thinks the company is worth. But sometimes if you could have a magic ball and you said, I know that this company is only worth $1 million, and yet it is being sold for $10 billion, like, wow, that just doesn't make sense that the price is so much higher than what it really is. It's not making any money. It has tons of debt. There's no future. I don't think it's worth $10 billion. So that's what investing is, trying to figure out. And then if you feel that the company's worth is worth more than it's trading, then it's good buy. If it's overpriced, then maybe you ought to sell. What's the future growth potential and what industry is it in? For instance, a few years ago, when Tesla was really hot because EV cars were in vogue. The last couple of years, it's been AI, companies in AI. So people are trying to figure out, hey, what are the big trends out there? And is it too late to hop onto that trend? Are there bigger trends and economic, political, or cultural issues? There sometimes, despite a company's best intentions, it might be a well-run company, might be properly capitalized, meaning it has money, everything is working in its favor. But let's say the current administration, let's say it's the Biden administration, the current administration says, we don't want X. And Congress writes a law that prohibits this kind of company from operating. That would be beyond their control. So there's sometimes circumstances beyond their control that we need to take into account. For instance, let's say the economy goes in recession. You might have a great company, but it's going into recession. So there are a few different ways to categorize companies. You have size, large down to micro. You have sectors. You might look at a company from that standpoint. Oh, are we in retail or technology, consumer staples? That would be kind of a Walmart, something that, hey, even when we go into recession, people still go to Walmart, for example. They still need to eat, that consumer staple, the financial sector, energy sector, etc. Geography is another way we look at companies. It's roughly divided into domestic companies in the United States, or non-US, or what we call international companies, or global companies are some combination of domestic and international. And the last category I mentioned here, a little different than the other three, and that is Companies are sometimes categorized as being focused on growth, and some are focused on value or dividends. So very roughly, when a company makes money, the board of directors, that company that, the board that controls that, the decision makers have a choice what to do with those profits. Option one would to say, hey, we just made $1 billion. We're going to reinvest that back into the company and we're going to grow the company more. That's a growth focused company. The other one, well, we made $1 billion. We don't need that extra money. I mean, at the end of the day, we're just trying to make money for our shareholders. We're going to give that money back to the shareholders in the form of a dividend. So those companies are less growth focused and more focused on dividends. So be sure to ask me any questions, by the way. And it is now 10:19 Mountain Time. So we have 11 minutes. We're clipping along. I appreciate everyone being with us today. So we also, another way to kind of categorize companies is what we call an asset class. So this is what we call a periodic table, looking at different areas of the financial system, different asset classes. If you look on that first row in 2004, this is going back the last 20 years, real estate, emerging markets, those are your like India or countries that are not like the United States, they're emerging. Small cap companies, large cap, meaning just small, we won't worry about the word cap. And so people are trying to invest. But what you can see here on this chart is that it's this ranks them the ones that did the best in that current year. And as you can see, they kind of go all over the place. So it makes investing difficult because you might say, wow, I want to invest in the hot thing. So maybe real estate, look here in 2004, 5, and 6, real estate was really hot. But then in 2007 and 2008, it was the worst area of the financial system. So it's really kind of difficult to look at that. Look at those. But what I'm going to do over the next 3 slides is that we've isolated 3 different areas of the financial system, 3 asset classes. Let's look at those, okay? So the first one is cash. So if you recall from our webinar, I think it was last time, there are 3 areas of the financial system: cash, bonds, and stocks. So let's talk about cash. If you look over the last 20 years, we've highlighted cash. And for me, a couple of things pop out. Number one is, in general, cash makes below average rate of return. That's why for long-term investors, we typically don't have that money sitting in cash, because statistically, you're going to get a lower rate of return having your money sitting in nice, safe cash. Cash is wonderful. So we look at 2018 and 2022. Let's look at 2022, just 2 years ago. Cash was up fractionally and everything down, minus 11, 10, 12, minus 25%. So cash is really good because you don't lose money sitting in cash, but you can lose a lot of money in the stock market on any given year. So if you don't ever want to lose money, you can put it in cash. But the problem is cash typically doesn't even keep up with inflation. So the irony is, some people say, hey, I don't want to lose any money, just put it in cash. The only guaranteed way of losing money is having it sitting in cash, because cash won't keep up with inflation. You're guaranteed to lose money, as ironic as that may be. Let's look at the bond market. The bond market, similar than cash, but maybe a little better, right? So you see in general a little lower than average, but you do have more of these in the upper category. In 2008, when the financial crisis hit, cash and bonds did well that year. 2011 was another year that the bond market did well. So you can see there are a few times that it did well. Let's look at real estate. Real estate, kind of all over the place. I'm looking here, and you have 4 times it was the best place to have your money, 3 times it was the worst, and everything in between. And lastly, let's look at large cap stocks. That means basically big, large US companies. As you can see, they have really done well the last 20. So much of the world's financial system and the money has come over to the United States in the big companies that we know, the Apple, Amazon, Google, Tesla, Costco, whatever. That's where money has been flowing really consistently. And when money flows into an area, that props it up. So that's an area that has been very good. We have, let's go to questions here. So a question is, the person says, I understand the principle of buying low and selling high, but does this advice still apply during an economic crisis? Would it be wiser to hold on to my money and wait for the market to stabilize? Wow, fantastic question. It is very scary to invest when the economy is falling and going south. Because let's say the market goes down a lot, we don't know at that point if it's going to continue to go down or if it's going to bounce back. So ideally, you want to buy it after it has gone down, but who knows, but that it's not going to go down more. So it is a question that is unanswerable technically. But in general, if you look, well, I guess those slides aren't quite the same thing, but we never know exactly what the future holds. We just know that in the long run, stocks go up. And we also know that the stock market is very efficient because people are buying and selling. Millions of people at any given moment are trying to predict the future. So for that reason, the idea that it's called market timing. I'm going to wait until the worst is over, typically does not work. There's a lot of research, a lot of data on this. Can you successfully, consistently figure out when the market is peaked, in which case you would want to sell at that point, or when it has bottomed? And in fact, it's just impossible. What's the best source for buy and hold that will keep up with inflation? So cash over time slightly underperforms inflation. The bond market is roughly on par with inflation, and stocks in the long run do a little better than inflation. So if you want to keep up with inflation, you really need to have at least some, if not all, of your money in bonds and stocks. Good question. Okay, we will move on here. To the last, it is 27. We just had 3 minutes. Why it's difficult to time the market. So the stock market is trading today, as a very rough rule of thumb, what the stock market is trading at today is looking about 1 year in the future. So if you think, hey, I think the election, let's say that's the United States election coming up in a few months, I think that this is going to happen. The stock market is already looking beyond that. So by the time you act on that, you're probably a little late. Or you think, hey, I think next summer we're going to go into a recession. So I'm going to wait until next summer. I'm going to keep investing because the stock market, I think, is going to go up. And then I think next summer the stock market's going to go down because we're going to go into a recession. keep in mind, you're not the only person. There are millions of people that are also thinking that potentially. And so they're thinking, oh, next summer is going to be a recession. I sell now. Rule of thumb, it's a year ahead. So if you're a prophet and you can think a year ahead and you're smart, good for you. Statistically, very difficult. So the last slide, I'll show historical rates of return. If you can look at this chart, this is last just under 100 years, since 1926. Maybe 28. You can see here the red is when the stock market has gone down. The green is when it's gone up. Approximately 70% of the time on an annual basis, stocks go up. 30% of the time they go down. And you can see if you look at 2000 to 2010, you had 5 years that the stock market was strong in the early 2000s. And then that went down. That was the 90s, excuse me. So you had a really strong in the 90s. And then look what happened in 2000, 2001, 2002. It just became overheated, and eventually prices had to come back. That was very painful for 3 years. The same thing happened. You had about another 5-6 years. Stocks started to become overvalued. And then in 2008, you had the financial crisis. Very, very painful. If you can see, it was almost as bad as the Depression 100 years ago. And in the last, 15 years or so, it's been pretty strong. So it would not be out of the realm to think, hey, you're going to have some pullback, maybe not expect the same strength over the last few years. So we don't know what happens year to year, but we just want to keep a long-term basis. That concludes us. It is 10:30. We appreciate your participation. Again, be sure to follow us, Navigate Financial on our Instagram, YouTube, Facebook, all that other stuff. We'll meet you again at our next webinar, Thursday, September 12th. What should I do with my old 401k plan? And we'll be sending you information about our upcoming podcasts. Thank you so much. We appreciate your business. We appreciate your interest. And we hope you have a wonderful day. Take care.